the rapid nature of the sell-off has made it, probably more disturbing than, well, than many that we've seen, and the left with the unknowns. I think what I try and talk about is, these kind of times make you zone in on the short term so much, and I think you have to look at history and think about the long term as to how this likely plays out. We know in the short term, all the things you've talked about already, which is it's likely to get worse in terms of the virus, et cetera, business disruption. But the long term is what you've seen in these kind of, similar situations, never exactly the same, is that once you get through, you do end up seeing a sharp rebound in activity. So as we think about companies, we look for, the normalized earnings and where are we getting opportunities. And I think that's what investors should look for. Secondly, you do have to think about there will be companies that, may not make it through the downturn because we don't know how long it's going to last. But so that's the other thing you really need to watch for. And I think that's part of what's going on. And you throw in the oil on top of it. And that also for the energy sector anyway is certainly part of the picture.
So that's a number of things there that we could dive a little deeper on. I want to start first with your comment about history. Certainly we've had downturns before, but have we really had a downturn that was spurred by what is now being classified as a pandemic? I mean, is this the same as what we've seen in the past? How much can history really be a guide here?
Yeah, no, it's never exactly the same, but I think when you look at, whether it's natural disasters, because this kind of falls under the natural disaster, some of that's easier is a hard thing to say. You don't want to say it that way. Some of it is the timing. It moves through quicker. We don't know how long this lasts. That's what makes it different. But anyway, you look at it, once you get through this, again, we typically have seen with any of these epidemics that you do see economic activity pick up. Hopefully, again, we've gotten ahead of it. Part of the what you think about is that you're trying to slow it down. You can't stop it, but you try and slow it down so it doesn't overwhelm the healthcare system. Things, again, you've been talking about is the worries. But again, you take all those precautions to try and make sure you don't get to that point.
So I think most of us do feel at some point there will be an end to this. We don't know when. We don't know when the market will bottom. But if you are an investor, is it best to just wait until you see a little bit more stabilization? Or should you have a strong stomach and put some money to work here if you can hold tight for a longer period of time?
Yeah, and I think that's the key, right? If you can hold tight through it, slowly moving some money in, again, using history as a guide, it's rarely been a bad move once you're down into bear market territory. Again, you have to think back to the financial crisis, 2000, the 1970s. Other than that, there aren't many times when once you get down 20% that you haven't been up in a year's time. So again, it takes a strong stomach, and certainly you've got to make sure you're set to be able to personally to make it through this sort of disruption if your job's in jeopardy, et cetera, and certainly those are things you have to think about as they hold that rainy day fund, but yet rebalance. If you had high quality bonds, obviously they're up a lot during this period, so you have an opportunity to rebalance a little bit.